check or your invoices, that's something that the IRS puts you in charge of. So even if you sell physical products, things of that nature, sales tax, usually at the state level, even has more implications, especially if you don't report it. So, make sure you do that. If you sell clothes, you sell gloves, things of that nature, make sure you check your state's website, your state government, see what the sales tax is on a monthly or quarterly basis, and make sure you're reporting. Even if you paid $0, you still need to self-report. The U.S. system is a pay-as-you-go program. So taxes are due as soon as you earn them throughout the year, all right? So don't think that, I can just make $30,000 one month, and the next 6 months I make $0, and I can just report it whenever. There's actually a schedule on the calendar on when a lot of these things are due and when they need to be paid. So we're going to kind of touch on that a little bit today, further on into the presentation. So I'm going to have people raise their hands based on what the correlating answer for you is. So how do you get paid right now? Anybody gets paid regular 9 to 5 salary? Okay, that's the majority of the room. That's all right. Employment. All right, now, who in here makes any 1099 or contractor money? Okay, let's do a good chunk of room. Okay. Mix of both? All right. Now, who gets just Cash App, Zelle, Venmo?
It comes in how it comes in.
Trade, however you do it. All right. And hopefully E doesn't apply to anybody. You should know how you're getting your money. So there are two ways to earn: W-2s and 1099s. W-2s is everything I just touched on earlier. That's where the withholding comes in, right? They're taking out that money every single paycheck to cover whatever expenses the government needs to cover expenses for, and they report that to the IRS. 1099, which a lot of you are in the realm of, is different. Like I said, you need to self-report, all right? However, if you're a contractor, even more so, because whoever pays you and gives you a 1099 form, that means they're also sending a copy to the IRS, all right? When they send that copy to the IRS is looking for you to report that same income on your tax return. If they don't get that match, when you submit your tax return to the IRS, come tax season in April, they're going to flag it, okay? Now, this also includes you Cash App, Zelle, Venmo people, and PayPal, right? Although no form is getting inherently submitted to the IRS, it is still upon you, and basically Scout's honored, to tell the IRS, hey, I made $50,000 in cash this past month, and you need to pay taxes on it. Because when I tell people all the time, the IRS, everybody says, I want to hire from the government has your information, no matter what. If they find it and they see it, they will come after you and they will get their cut, okay? So make sure that you're doing your due diligence to report all sources of income that you make throughout the whole year. So the thing with being a 1099 individual is that you have no safety net, right? It's really upon you to self-report. You have no HR department, you have no payroll department, and you even have a different tax on top of, if you're working not regular 9 to 5, that's on top of your withholdings. So it's usually around 15.3% net profit. That sits on top of your regular income tax. Income for you can be inconsistent, right? I just talked about it. You might make $50,000 one month, the next month you might make zero, right? You have ebbs and flows usually. It's usually not very consistent. So even then, you really need to take time to track a lot of your expenses and your revenue during that time to make sure you're doing your due diligence. The good news is that your expenses are lower for your taxable profit, which means good tracking literally saves you money. And we'll get into that a little bit later.
And those that raise their hand that have a business, contractor, let's just see real quick, what does that look like? So if the business is just you into one person shop, go ahead and raise your hand. Okay, let's do a mix. And then same thing, but you actually have employees. It usually gets smaller, it usually shrinks. And then who's thinking about it but hasn't started yet? Anybody? It's all right, okay. It's good amount of people, okay? So we're going to talk about a little bit corporate structure. What does that look like? Especially for people that just raised their hand and you're getting started. This is something that's very helpful for you to know. Kind of what are the different types of businesses that are there? This slide's going to go through some, but the next slide's going to go through some of the other options that you'll have. But we're going to talk about very quickly what is the difference. And so the first one that we're going to talk about first is sole proprietor. People that raise their hand and we say it's just you. It's just you. This is going to be you. So you are the business. It's John Jackson, Jeanette Jackson, if you may. That is the business. And so that person's going to be required to still file their taxes on a form called Schedule C, a Schedule C. There's no liability shield. We're not going to get to legal territory necessarily, but you don't have an LLC or something in place to protect you if something happens from a liability perspective. It's the cheapest and simplest to run. So you just kind of start doing it, receiving money. You're still going to have to report, as Herb was saying, but it's kind of already happened. You said you get paid as Jeanette Jackson, if you may. So sole proprietor is the first one that we're going to talk about. Next is going to be an LLC. So it's the same situation, but that same person, instead of just, starting to receive money, they got Jeanette Jackson LLC instead. And so now you're behind the shield as far as an LLC is concerned. But from a tax perspective, it's the same exact thing as if you were a sole proprietor. So you're still going to file that Schedule C, right? You're still going to have, track your expenses, track your income. There's not a distinct difference from a tax perspective, but from a liability perspective, having an LLC as a single member or just you in the LLC allows you to have some protection. But from a tax perspective, there's not a significant difference. And then lastly, I asked you to raise their hand if it's you plus a partner or multiple partners, it could be. That's going to be our third slide, which is partnership and multi-LLC. This is going to be an automatic change. The second you have more than one person in the LLC, you can't file a Schedule C. We have at least, 10, 20 people a year that come with prior tax returns on a Schedule C. They have like 4 or 5 partners. And I don't know how they made it this far with that point. Form 1065 is a partnership tax return. So really, if you're thinking about, what am I doing, who am I working with, who am I in partnership with, if you have multiple people, there's a different tax form. And typically, this is a little tough for people doing their own, and that's usually when accountants like us get people to reach out because things get a little bit more complicated. A partnership, you really have to get an agreement in place as well, especially if you're getting into business with other people. It's always beautiful when you get started. You got that feeling in your gut, that butterfly feeling, you're going to get excited. But things always get funny, things always get complicated. And that operating agreement helps dictate when things go wrong, what happens. When things go right, what happens, right? And so a partnership is going to be something I would really, do you have to do it yet, right? We see a lot of people just have a joint venture. We're going to take our 2 businesses and do something together and get paid separately. A lot of times we say it's easy to get into, but it's also very difficult to stay in and stay compliant. And so if you can take a second and kind of think about, do I have to do this just yet? Do I have to file this? That really can save you a lot of compliance and heading down the line, I'd say. And so to the next point, we're going to add 2 more to the equation. So you'll see we have our solo, we have single-member LLC, multi-member LLC. We have 2 more entities that we have added: corporation and S corporation election. That bottom one is not an actual entity that you can create with the state. It's a tax election. But the first 4, for the most part, are some type of entity you can have. C corporation, the 4th one down is the one that we haven't discussed yet, that is also going to be added in this equation. A lot of times people shy away from this because it's one of the hardest ones for someone to really wrap their mind around. It's one of the harder ones for someone to remain compliant on. But it is one of the ones that gives you complete separation. It draws a line in the sand, if you may, from Jeanette Jackson to whatever this business is. It's its own person, if you may. But it also gets taxed at the highest rate. So we oftentimes advise people on holding off on a corporation until it really makes sense. Are you going after a large asset of some sort? Are you really going after some type of thing that requires you to have that separation that really makes the most sense? And so that will file. We mentioned Schedule C. You'll see 1040 plus Schedule C. Below that, 1040 plus Schedule C. And then you'll see the 1065 we briefly discussed. There's a new form that comes into play
know, if you're just going to be a mom and pop shop, do the first three. If you're trying to become the next Black Walmart, you look at Escort and C-Corp. Those are going to be the dividers in your mindset of what you're trying to do with your business.
So pick your structure for liability and growth first, then run the math tax or tax math before assuming savings. Sometimes you can do it on your own. Oftentimes we recommend bringing in a professional. They can give you a succinct answer really quickly to let you know if this is a good idea or not. So I'm going to talk about you own your taxes now. This is the person that money has begun coming in. Things have gone horribly right, if you may, but now you haven't set anything aside for taxes. It's time to file. You might do it in your own internal tax. You might have someone do it for you, and you got this number, this red number in internal tax. So it doesn't look pretty. So what do you do? What happens next? First, please read. Owing tax at tax time is extremely common for self-employed people. You shouldn't be self-employed without a W-2, having things withheld, and getting massive refunds unless you have kids or other tax credits. Usually you should owe. It's a matter of how much and how can you reduce that, as opposed to, I'm getting a whole bunch of money back automatically, especially if you're not getting anything, taken out of your checks, or you're not paying the quarterly estimated taxes. And so the bill, if you already owe, can grow in two ways. One is a failure to file penalty. We call it the big one for a reason I'll talk about in a second. And the other one is a failure to pay penalty. Two separate things. Both are pretty mean and vicious if you don't address them up front. And so the biggest thing I want to leave you with as far as the failure to file penalty is you're paying approximately about 10 times more in overall penalties and fees in comparison to a failure to pay penalty. And so I think the biggest thing I want to leave people with on this particular slide is please file. Don't be scared to file just because you owe. Get that return in and get it in on time, because there will still be penalties and fees associated with not paying. But if you just don't file just because you might be scared or just apprehensive, it's a lot more expensive for you in the long run, and that tax will get paid eventually, even if you don't want to pay it now. They're going to come for it. They're going to take it from a paycheck. If you quit doing the business to get a job later on, they'll actually garnish the wages of that job. Should you have a balance that's due to the IRS. So get that return filed, and then we'll talk about what you can do if you don't have enough to pay in a second. So filing late is almost always more expensive. They're not the same size, and the IRS would rather set up a plan and know what the amount is than chase you down. It's more expensive for everyone involved. And so please file first, and then you can figure out how to pay, and the slide we're going to go to next. And so we're going to quiz the room real quick. $3,000. College tax, $3,000 is what you're saying to do. Who right now says, I've set enough aside, I can pay that company? Raise your hand. Okay. Who's like, maybe, I might be able to take some out.
It's 2026, we all broke. Okay? Look, milk is $8.
Who could say no? I don't know how I done that. It's good. And then, who's like, what am I'm supposed to set money aside? What are you talking about? Anybody on there? It's all right, you don't got to. And so, to our next slide, options when the bill is bigger than the bank account. This will happen typically for business owners that we work with. They're in their first or second year in business, right? They got down how to make the money, but the other things that come along with making money haven't yet creeped in. That's typically the situation we'll see someone in when they come to us. The business is working, but the compliance is not together. And so it's not necessarily uncommon, but especially if you haven't started yet, consider this to keep yourself from digging yourself out of a hole later on. And so a couple options that you have. Number one, pay what you can now. So you say 3,000, we got 500, put down the 500. Pay something towards it is what we highly recommend to at least begin to get that balance down. The IRS will allow for a short-term extension, so usually up to half a year, to pay the balance in full. And so there's a form you can fill out that lets you, tell them, hey, I intend to take care of this. And there are oftentimes, pause their collection efforts. Sometimes they try to levy. It gets very ugly. And those things will get paused if you reach out proactively and say, hey, I need an extension. Number 3, installment agreement. You are allowed to create your own installment agreement on IRS.gov. You can put in your information, confirm who you are, and if it's under $50,000 that you owe, you're able to create an installment agreement that allows you to make monthly payments. Typically, you can choose that amount towards your tax bill over time. And then 4th, once fix it going forward. Harold's going to talk about a little bit what estimated taxes look like, how do you calculate that, how do you pay it. This is something that's very important. And I also want to know, we're talking about dealing with the IRS. Everyone here is from a different state. And so as we talk about paying taxes to your state, to the IRS, you're also having the same things in your state depending on their taxation rules. We're in Ohio, so we also have localities. You got to pay your city too. And so considering all these pieces is very important. And everyone in here can do what they do quite well. Can you do everything at once? It's kind of difficult. So bringing in a professional to tell you what to do, what not to do, can oftentimes keep you from having a lot of headaches down the line.
And I want to touch on something else on that. Even when you do set up the installment plans, right? You're like, oh yeah, I'll pay it off over 3 years. The IRS might pay you what they took, but when you pay them, they're going to expect more. A lot of the payment options that are going to be available to you are going to have interest tag on top of it, right? So you also have to take that into consideration of how much am I going to pay right now, right? Am I going to make a sacrifice? Am I going to not get that bottle of Don Julio this weekend? Am I, maybe I won't go out, and it's the state break this weekend. I'm going to do that, put an extra $25 for my tax bill, because that might save you a little bit on interest, because you're always going to end up paying more than what you truly owe when it comes to those type of situations, it comes to those type of tools that's available to you. All right, so now to the good stuff, right? We're actually going to learn about what you can do to not owe the IRS too much money. Because that is the end goal, right? The number one money tool that we always try to reach are business deductions. All right. So everybody who has their own business, raise your hand again. All right. Everybody that keep your hands up. If you brought a business card with you, keep your hand up. If you promoted your business while you were here, keep your hand up. Good. Guess what that can do for you? You are able to deduct your expenses from this whole DreamCon trip. Your registration, tax deductible. Some of your meals that you had this weekend, tax deductible. Anything down, if you go down to get some merch, get a t-shirt, maybe not so much. Maybe not so much. But when it comes to business deductions, there are 4 categories that they need to fall into, right? Ordinary, necessary, business connected, and documented, right? That t-shirt probably doesn't fall in any of those 4 categories. But say you had a meal, say you've been handing out some samples or something this weekend, your travel arrangements, your registration, those things are tax deductible because they fall into these 4 categories, right? If you bought say you forgot a lens on your way here for DreamCon, you needed to go to the store, you bought a new camera, you bought a new lens, and it was related to your business, that is tax deductible. Production gear, software and platforms, if you purchase any of the internet amenities at the hotel or at the convention, those are tax deductible. And everybody has a house or apartment, right? If you have a business, you should be deducting a business expense related to your home office, right? And that, a lot goes into that. You got a water bill, you got an electricity bill, you pay for internet, right? As a normal person working a regular 9 to 5, you don't have the ability to take advantage of that. But having your own business allows you to take that vehicle and use it to eat up against any tax liability you might owe the IRS throughout the year. Okay? Like I said, we touched on traveling meals. Anybody in school right now? All right? Typically, you cannot deduct your education expenses on your personal side of your tax return. However, having a business allows you to take that education expense, as long as it's related to what you're trying to do, and eat up against any money or profits that you make throughout the year to reduce your tax liability, right? So there are a bunch of tools, there are a bunch of options you can utilize to be able to help yourself out throughout the year. Number 2, tax credits. So tax credits kind of hit harder than deductions do. However, they are very far in between. That's why they're so good. Credits you can hear about, credits you may hear about, eligibility is a fact-specific thing, and you must confirm before you count on one, right? So if you contribute to a retirement account, right? That is a credit. You also have education credits, right? You get your 1099 from school, you got your tuition or whatever right there, that's a credit. Like I said earlier, you kind of have to account for it in a different way on your business expenses rather than your personal in that matter. Energy and home improvement things, right? If you have a home, you can take some of those expenses, whether it's mortgage interest, any improvements to the house that you make throughout the year, and you can also put it on your tax return as it correlates with your home office. Employer credits, some businesses qualify for. You actually pay people, right, to do work throughout the year because you're hiring, you're paying for health care, you're paying for their retirement, and also retirement plan startup, and also any other amenities that you might be offering them throughout the year to work for you.
I'd say,
One of the big things we see in tax credits too, those that have kids, those are one of the strongest tax credits that we'll see, period. You get a couple thousand every single year that goes directly against whatever your tax balance is. So one of the rare circumstances where we'll see someone actually get a refund that's self-employed, usually there's tax credits, heavy tax credits involved. And so the use of them usually is most heavily scrutinized by the IRS. But it's a tool that can really help bring down an actual tax balance if it's utilized correctly. And so especially we'll talk about record keeping a little bit. Keeping records of things helps you really defend these types of tax credits because especially for those of you that are not W-2, you get your checks from your customers, clients, what have you. This is one of the saving graces of bringing down your overall tax balance. And sometimes even giving people a refund when nothing is being withheld throughout the year.
All right, the next money tool, estimated tax payments. I'll be honest with you, this is probably the one tool I see overlooked the most. The reason being that IRS gives out the tools to be able to do these things, but they never tell you that they are there, right? They want to get your money. They want you to overpay because they're going to use your money regardless for whatever what they want to use it for, right? Estimated tax payments are tools that allow you to pay or basically prepay upfront what you might owe next year, okay? A good rule of thumb that me and Mo constantly preach to our clients, 25 to 30%. I know it sounds like a lot. I know you want to get the new Honda Accord. Stay with me. I know you want to be able to take your old lady out. You know, go get some Ruth Chris. I'm not a state person, but I know there's some taking people out there, right? They got some good rolls now. 25 to 30% of what you make, you need to set aside in a separate account. Kind of tie back to what you talked in earlier. When you have that LLC established, you actually are able to set up a business account with a private or public bank. That way, that'll allow you to separate your personal and your business expenses, be able to do what you need to do throughout the year, okay? If not, you need to make sure you're self-tracking, whether you got an Excel sheet, you got your old school pen and paper, however you do it, you need to make sure you're tracking that throughout the year so that you know, like, hey, I made $5,000 this month. I need to take 25 to 30% of that and set it to the side. What happens is the IRS gives you 4 days throughout the year to make payments. Q1, April 15th. Q2, June 15th. Q3, September 15th. Q4, January 15th. Now, these are deadlines. I emphasize the word deadline because just because it says you need to make the payment by that date, you can make as many payments as you want to before that date, as long as you make a payment. Don't wait till the 15th of that quarter to make a payment. If you need to sit there and say, hey, I'm gonna forget. Look, I'm trying to go to DreamCon next month. I ain't trying to pay that. If you know you're gonna get paid $500 or $1,000 for a contract next week, as soon as you get that check, take 25 to 30% of it and give it to the IRS. It automatically gets logged, they track it, and they record it up against whatever you file next year, and that's how they reduce your liability. They say, oh, you owe $15,000. Oh, information so they can keep a good record and keep a good track of that, okay? So don't wait till these dates. Whatever money you made throughout the year, whether you get paid tomorrow and you want to make that payment tomorrow, make it tomorrow. If you want to wait at the end of the month every month, make it at the end of the month every month. But if you need to set a reminder to make that payment by the quarter, please do that, because if you wait and you make money in that quarter and you don't make that payment, there's a penalty associated with that, all right? So keep that in mind. Don't wait. Pay that money as soon as you get it.
So another quick quiz. So what we're gonna do here is we're gonna ask who thinks is true, who thinks is false. When I say true, I want you to say you're, or if you think it's false, when I say false, I want you to say you're. We're gonna get 2 yours, and we're gonna figure out what people want the most. So forming an LLC automatically lowers my income taxes. First and foremost, we're gonna go for the trues. Who thinks it's true? Let me get a year on 3. 1, 2, 3. Okay. Now, same thing for false. 1, 2, 3. Yeah. Okay, Okay, one more time. Forming an LLC automatically lowers my income taxes. False. I need a year on 3. 1, 2, 3. Yeah. Okay, that was a little better. Absolutely false. So by default, the LLC is taxed the same as the sole proprietorship. It's one of the first things we went through today. Real tax savings usually come from an S corporation, and only once profit is consistent after running the numbers.
All right, so tracking your profits throughout the year, all right? You need to separate the money. If you have a business, you can keep a track of it throughout the year, and the money that you get from work, you go ahead and track your personal account, and you can have that throughout the year, all right? Second thing, route it through. Business income and business expenses, not just your personal Cash App or whatever you might use, right? Cash App doesn't filter those things. It doesn't say what's what. It's going to pull all those things directly together. And if you wait too long, you wait till the end of the year, you'll get to a point where you have to sift through hundreds of transactions and figure out what goes where, and figure out, oh man, was this my aunt's me $25 for gas? I didn't have money for gas this month. Hey, it's real, I understand. Or I made $500 on vendor sales at DreamCon, right? You need to be able to separate those things out.
I think one of the biggest things, number 3, really picking a tool that really helps you keep track of this type of stuff. There's a couple options. I mean, QuickBooks is one of the biggest ones that most people have heard of at least once. I'd like to leave this group with Wave. I don't know if you've looked into it, what have you, but it is a free accounting software. They make money off of some upsells and some invoicing. They get transaction fees. It's a very easy to use kind of entry-level accounting software that we see a lot of people have by the time they come to us. Is it perfect? Not necessarily, but at least they're keeping track of their things. And one of the greatest tools that we like is when you have your LLC, you have your business bank account, that everything is flowing through that bank account. But these types of software allow you to do is to connect your bank account to the software. And so it's importing these transactions through. It's able to, using AI, usually maybe 60% accurate, guessing what buckets, what categories these things should go in. But it allows you to have pretty much financial statements throughout the year without doing much, setting aside an admin hour maybe once every other week or so. Allows you to really track. So Wave, I would say, if I can leave you all with a free software that's worked quite well, definitely I would say look into that. Sometimes people just track it in their spreadsheet. You're out, so there's nothing wrong with that. That can be defendable as long as everything substantiates. And there are some templates we can share as well that help you track that relatively easily. Reconciling monthly. So I mentioned kind of period of going, at least monthly, you should know how much cash do I have? How much did I make? If you aren't able to really answer that question, there's some rising anxiety that's probably coming into your business, which then leads into your life. And so kind of getting a grip on these things, making sure you know this type of information, really helps not just empower you, but really help you make decisions for your business long term. And then keeping a paper trail. So receipts, invoices, mileage, 1099s, W-9s from contractors, all of that information is very important to keep. And so when all else fails, file it away. Put it in the same place.
have an automatic record keeper in your hands right now. Okay? You buy anything, you buy food, you go anywhere, you buy your plane tickets, email, text messages, go ahead and take a screenshot of it, set up a Google Drive, drop it all in there throughout the year, right? Because that is going to be the easiest way outside of, I'm going to staple 100 receipts together. You're going to lose a receipt, and that one receipt might be worth $800. You're going to be butthurt about it. Trust me. Trust me. Any money that you can track throughout the year is money worth reporting. Okay? So use your phone to invest disabilities. Even outside the free tax software, who's on her QuickBooks? If you use QuickBooks, if you haven't utilized QuickBooks, that one does come with a monthly fee, usually, depending on what they might have to sell or anything, or a promotion going on throughout the year. But it allows you to connect your bank accounts. It allows you to take the photos that you took of your receipts and upload them directly to the software, and it'll actually connect whatever transactions come through your bank account to that receipt that you took a picture of, okay? And it makes that tracking a little easier. So that's just another tool that you'll be able to utilize for record keeping purposes throughout the year.
Just a whisper, keep you guys busy a little bit. How are you tracking your income and expenses right now? Just raise no yours this time, but who here has a business and is tracking with accounting software? Any accounting software, raise your hand.
All right, so we got about four. So we got about four. Okay.
Who's using maybe an Excel spreadsheet of some sort? Anything? Okay, it's all right. It's all right. Who's using their actual banking app to tell you some information? Okay. Who has a shoebox of receipts? All right. Okay.
Oh, y'all worse than my grandma. She's eating pants in the cereal box.
And then who has nothing yet? It's okay to have no plan as long as you intend to.
Don't be shy. It's okay if you don't have nothing.
That's all right. I see you back there. Okay. Whatever you are is fine, but the goal is to have one system that you actually keep up with. A lot of times people put together these really nice plans, and they can't keep it up after a week or two. So what are you doing? What are you setting up? You keep coming back to is like half the battle. It's just being able to keep up and remain consistent with it. So if you're using a pro, if you have a pro that you're using right now, an accountant of some sort, to help you with your taxes, please tell them everything. Your preparer can only protect you with the full picture. It's oftentimes when we get people that come in for the first time, they're a little apprehensive. Tell us the full picture. We'll see this type of stuff quite often. It's probably not going to be the wildest circumstance we've seen. I can promise you that. It's the same thing for any professional that you're working with. So bringing all the messages or surprises that they find later can cost you more than if you just share it with them up front. And so a preparer should be working in your best interest. How can they do that if they don't have all the information of your situation and your story, right? So they're not going to judge you. They've seen it all before. I promise you they have. Honesty means more deductions found for you, right? For you, and fewer notices coming back at you because maybe there was some type of $3,000 came in, but they paid me via cash, that's all I'm going to tell them. Well, now the IRS somehow found out about it, and now we're getting a notice that your overall tax bill was corrected.
When it comes to looking for a tax professional, it's the same thing as looking for a doctor. It's the same thing as looking for a mental therapy consultant. It's the same thing as looking for the right school for your children, right? It's not a one-stop shop. You should not just find one person and stick to that one person because that's the first person that you found. You need to look for a tax professional that, one, is right for your situation, your income, and also is going to do the wherewithal to go above and beyond to find the resources necessary for you to be able to have a better picture at the end than when you started, okay? And it's not just, hey, you send me your stuff, I file it, and I send it off to the IRS. It's throughout the year, you find ways and avenues to have a better picture than when I started with you. And then we continue to build on top of that so that when you eventually grow and expand, right, we set a relationship and we set a platform to where we're able to launch you into the stratosphere to where you're actually trying to go. But when you don't do that, you're just going to be chugging through the mud. And it's going to get harder every single year. Further and further along you go down and you don't do your due diligence to make sure you find the right person for you. Just like you try to find the right person in your relationship that you're married, you know, maybe some of us don't like who we married. It's okay. It's okay. Maybe you don't like hers. It's fine. But it's the same thing. You should have as a type of relationship with your tax preparer or your tax professional or your CPA as you do with your best friend, your mom, your daddy, your niece, your uncle, your cousin. And not that one cousin that we all got. All right? So make sure that you're doing your own due diligence to get everything, but to also make sure that the person that you're giving everything to is right for you.
So what are the tax lawyers telling you? So there's a couple things we can do to help. If that time comes for you, you have a business, you have a complex situation, you can help navigate it. So a couple different ways. So formation and structure. Help you choose and set up the entity that fits for your numbers and goals. That's the list of 5 different entities that we went over a little bit earlier. What's the order? What's the one that's best for you? Helping you navigate that. Bookkeeping setup and cleanup. So allow getting clean current books, from scratch or from a mess. So you could be getting started, right? We can help you, keep that train together, or we can help you keep your train back on the tracks. Tax prep and planning, so filing it right and planning ahead. So that when April comes, it's not a surprise. You already kind of know what it looks like. You've already done things throughout the year to help bring that balance down. And then lastly, contractor and estimated tax help. So people that we mentioned that raise their hands and you have a business just you, but you have a team of contractors that are paying to help you out. How do you deal with it? What are your extra deadlines for dealing with them and paying those types of people? And then helping you navigate what's that quarterly tax payment? How do I pay it? Who do I need to pay? Those types of things. And so, serving creators, freelancers, and small business owners in all 50 states. And so the next step would be to help and complete the tax lawyer's questionnaire. We'll leave it up here. We'll